Core principles of GAAP, detailed overview and explanation. Introduction to GAAP principles. Generally accepted accounting principles ensures consistency, reliability, and transparency in financial reporting. GAAP principles are developed by authoritative bodies like FASB, Financial Accounting Standard Board. GAAP principles serves as a foundation for financial reporting standards. 1. Principle of regularity. Entities must adhere strictly on the GAAP rules. Ensures consistency in application across entities and periods. Second, principles of consistency. Same accounting method should be applied over time. Changes must be disclosed, including their effect on the financial statements and the reports. 3. Principle of sincerity. Financial statements must fairly and accurately reflect the entity's position. Focus on unbiased and honest reporting. 4. Principle of prominence of methods. Accounting method must be consistently applied. Example, straight line depreciation should not be arbitrarily changed. 5. Principle of non-compensation. Financial statement must present a complete picture. Offsetting assets and liabilities or income and expenses is not allowed unless explicitly permitted. 6. Principle of prudence. Conservatism. Exercise caution in estimates and judgments. Recognizes revenue only when reasonably certain. Recognizes expense as soon as apparent. Principle of continuity. Going concern. Assume the entity will continue operating for the foreseeable future. If this assumption is doubtful, it must be disclosed in the financial statement and the audit reports. 8. Principle of periodicity. Report financial activity over specific period, example months, quarter, or year. Allows stakeholders to assess performance and trends of the business. 9. Principle of full disclosure. All relevant financial information must be disclosed, including the changes in accounting method or contingent liabilities. 10. Principle of materiality. Record and report transactions that are material to users. Insignificant transaction may be omitted without impacting decision making. It means the transaction which are immaterial and which doesn't impact on the decision making can be omitted. 11. Principle of historical cost. Assets are recorded at their original purchase price. Fair value exceptions are explicitly outlined in GAAP. 12. Principles of revenue recognition. Revenue is recognized when earned and realized. Governed by AAC 606 with 5-step model for revenue recognition. This will be discussed in the later part. 13. Principles of matching. Expense must match with the revenue they help to generate. Example, cost of goods sold is matched with the related revenue. Principles of economic entity. Business activities must be separate from those of the owner or other entities. Ensure financial statements reflect only the entity's transactions. 15. Principles of monetary unit. Transactions should be recorded in a stable currency. For US GAAP, this typically the US dollar. Significance of GAAP principles. Ensures consistency, comparability, and reliability of the financial statement. Protects stakeholders by providing a true and fair view of financial health. Conclusion. GAAP principles are the backbone of accounting standards in US, foster trust, transparency, and ethical financial reporting, guide professionals in preparing reliable financial statement. Thank you for watching. Subscribe to the channel for upcoming videos on accounts and finance.